Hello and welcome to our course today in Fundamental Analysis. Throughout history, there have been several global crises that have emerged in different countries, and each has a different explanation. Some articles mention problems that have arisen in the economies and that can still be presented in the future. The first issue to be discussed is the crisis that occurred in 2007, which originated in the United States. There are four recognizable phases in the economic cycles experienced by all economies: crisis, recovery, boom, and recession. There have only been two periods in recent history of a drastic increase in the price of housing in the United States. The first period was in the 1940s during the Second World War, and was due to the low construction activity in this period, and an increase in demand when the war was over. The second episode of a drastic price increase was the first decade of the 21st century, but this second episode cannot be compared to the phenomenon of the Second World War. Construction costs were declining and demand grew, but not in great magnitude. As the price growth was fast, the prices could not sustain this trend and ended up decreasing close to 30%, which led to the entire US economy collapsing, along with other countries that also saw the housing market was in balance. The effect on the economies was magnified because part of the income of the families came from this market, since they had investment instruments, so the price reduction ended up affecting household consumption. The prices increased drastically, first because of very low interest rates that gave liquidity to the market, making the loans more affordable, and second, due to the total euphoria of the consumers who had the belief that real estate prices would never fall again. The nominal interest rates were low since inflation was low, so the central bank had no incentive to increase these rates, and since the housing price did not directly enter the inflation indicator, it did not generate inflationary pressure. The financial crisis that began in the United States spread and ended up affecting most advanced economies and emerging market countries due to trade. This is the main problem of globalization because, with the opening of the market of goods, consumers spend part of their income on foreign goods, and as consumption in the United States was depressed, also the demand for foreign goods was affected, which ended up affecting production in other economies, especially those that depend most on international trade. It is true that with the implementation of new financial products, most of the mortgage assets in the financial system of other countries, so the fall in housing prices ended up affecting investors and banks around the world. The economy of countries is not stable in any case. They always have oscillations that are called economic cycles. The economic cycles are the recurrent increases and decreases in the economic activity of each country, and therefore the economic sectors are also facing these fluctuations in the economy. These oscillations do not occur in the same way or in the same magnitude, since the factors that affect an economy are different in each period. Economic cycles can be calculated by analyzing some economic variables. The most used are the gross domestic product, also called GDP, inflation, and unemployment, amongst others. Some variables are pro-cyclical. This means that they increase when the economy grows and decrease when the economy decreases, such as GDP and inflation. There are other variables that are counter-cyclical, which grow when the economy gets worse, such as unemployment. After the crisis of 2007 and its continued depression, the recovery phase began in 2009. Since 1949, the United States economy has had 11 expansion phases and 11 recession phases. The expansion phases have had an average of 21 consecutive quarters showing growth. The current economic cycle of the United States is above average in its growth phase, growing close to 32 consecutive quarters since the third quarter of 2009. but the growth has not been of the same magnitude as the most euphoric episodes of the past. Although each economic cycle is different, and patterns are not always repeated, there are indications that global economic cycles are slower in their recovery if the origin of the crisis was a financial crisis, like the one in 2007. The recent crisis of raw materials between 2014 and 2015 has led to the dependent economies of oil, copper, and other natural resources into an economic crisis. In some cases, they have seen their growth reduced without quite reaching a crisis. As with the economy, raw materials have seen their price fluctuate over the years, so it can be concluded that these variables have often been correlated. With an increase in population and its consequential demand for energy, energy sources have been reduced, which has led to the prices of coal, oil, and other raw materials to fluctuate dramatically. This has led to booms and falls that have affected many economies, because their main source of income is the exploitation of these resources. As has happened throughout the history of mankind with changes in demand, energy models change. At present, there are problems in the environment caused by the exploitation of fossil fuels, which has led many analysts and economies to rethink which energy model their economies should be based on. The causes of the 2014 crisis in the oil market were mainly due to three factors. The first factor is the development of the extraction of unconventional hydrocarbons, such as fracking. This has allowed non-OPEC countries, such as the United States, to increase their production in an accelerated manner. The second factor that determined the crisis of recent years was the decision of OPEC to maintain its production at the same level, so as not to affect the market share of each country that was a member of the organization. And the third factor was the weak demand for raw materials, including oil, due to the change of the Chinese economic model and the weak demand of European countries. These were all products of the crisis in 2007 that affected the growth of most countries in the world, and its recovery was very slow. In this recent case, the raw material crisis was caused by a change in the energy model due to the change in the economic model by China, a country that wants to stop relying on exports and based its growth on domestic demand. As mentioned in the previous presentation, it is necessary to be informed of these macroeconomic events in order to make investment decisions. If a country depended on raw materials as a fundamental part of its income, it was evident that, as with the crisis, its economy was affected and its currency depreciated with respect to more robust economies and to the dollar. If a trader is aware of these relevant notices, they will be able to act in the market in a more rational way and with better results. We hope you enjoyed our presentation. Thank you for your interest, and we'll see you next time at Forex Academy.